In late 2020 and early 2021, AT&T was one of my favorite positions for a long-term as well as short-term trading opportunities. Once they announced they would be spinning off WarnerMedia, which included HBO Max, things changed. Upon hearing the news, I sold my position, locked in some short-term gains, and in the last 5 to 6 months, the stock has continued to fall into the $25 range. Now that there's been a 20% slide in AT&T stock price, I think now's a perfect opportunity to take a step back and reevaluate AT&T for a short-term or a long-term trading opportunity. All right, so there's a lot for today's video. First, AT&T and what will be left after the company spins off WarnerMedia. We're going to go over some dividend information. We're going to look at the segments and the financials of the company. And we're going to look at some tailwinds and headwinds for AT&T moving into the future. Next, we're going to look at WarnerMedia as an individual unit. We're going to look at growth. We're going to look at how it's done financially. And we're going to try to see what it's going to be as the X factor for both trading AT&T and Discovery. Next, we're going to look at Discovery and some of its history. And we'll also provide the price performance for both AT&T and Discovery kind of side by side, so you see how they've been trading in the last few months since the news. And then finally, I'm going to go over some thoughts, my strategy, and some price target for both AT&T and Discovery. Welcome to Frank Finance. I do videos on personal finance, investing, and stock analysis such as this one. If you like this type of content, please consider subscribing. I appreciate it more than you know. Also, if you enjoy this content, please hit that like button. Thanks so much for watching. Now to your content. All right, so hopping right into it, AT&T has been making some moves in the last year. First, they announced that they'd be spinning off DirecTV. Now, this was actually a large percentage, I would say a large percentage of their income, amounting to about $30-something billion, $31 billion, about 22% of their total revenue. And they completed that spinoff in August of 2021, a few months ago. Details of this news, 70% was going to be owned by AT&T and 30% by TPG. And then the next thing that they announced back in May of 2021 was a spinoff of WarnerMedia to Discovery, DISCA, D-I-S-C-A. Now, that is anticipated to close in Q2 or early Q3 of 2022. And so what is going to be left of AT&T after both of these transactions are complete, one being DirecTV, which is already closed? Now, the main two segments that are going to be left is mobility and wireline. These numbers are for Q3 of 2021. Now, their mobility side has performed strongly year over year, about up $1.2 billion. And they also have an EBITDA growth of about $0.3 billion, while the margins have decreased on the mobility side from about 43 to about 41%. They've added in that time period about 6 million ads since the previous quarter. So this isn't year over year, but since the previous quarter. And it's the only sub-segment to not experience a year-over-year loss in revenue. So this is the core of their business, and this is the core of what will remain. So it's good to see that this is fairly stable from a revenue perspective. But one of the challenges is that they're having increased competition. And we'll talk a little bit more about that in the headwinds and tailwinds section. On the wireline side, business wireline went down by about $400 million year over year to $5.9 billion. They saw a decrease in EBITDA, and they also saw a decrease in EBITDA margin. On the consumer wireline side, we saw a slight increase of about $100 million. EBITDA was at about $1 billion, and on the EBITDA margin was up slightly. Now, on wireline, we saw about 1 million net fiber ads, which was a positive note. And another positive note here is they saw a lower attrition rate on the cable subscriptions at a little over 600,000 net losses. Now, we talked about this before, but basically they do expect those cable subscriptions to continue to go lower and lower year over year, just as streaming becomes more and more mainstream. And this is kind of why having HBO Max was a kind of a little bit of an offset for them. And losing that is going to just continue. This is going to continue to be a point of attrition here on the cable subscriptions. All right, moving on into dividend information. Prior to the spinoff of WarnerMedia, AT&T was offering a pretty juicy 7% dividend yield based around their current prices. Now, currently, with the movement and selling off and spinning off two high revenue producers for their company, that being DirecTV and WarnerMedia, AT&T has to reevaluate how much they're going to pay in their yearly dividend. Now, AT&T came out and said they want their annual dividend payout ratio between 40 and 43% of about $20 billion in free cash flow, implying a $8 to $8.6 billion of dividend payouts. Now, all that being said, it would put the stock at about a low 4% dividend yield, which is a pretty substantial change from around 7% where they were prior to the announcement. So right now, I believe that payout ratio is a little bit higher. However, once this company is spun off, they're going to adjust the dividends. So if you are a dividend investor, if you are counting on this as income, there may be a crucial decision here to be made. And that honestly might be why you've seen this stock continue to fall over the last 6 months, as folks who could be investing as this for dividend could be saying, hey, there's going to be a sharp cut here, and even though I'm going to own Discovery after the spinoff, they don't offer a dividend, which if you are relying on it for income, it could be a very big decision-making factor for a lot of investors. All right, so next up I want to highlight some of the financials for AT&T. So looking at revenue, you can see that revenue was stagnant from about 2008 all the way to about 2016, where they saw some growth in between 2015 and 2016. This also saw some growth in 2018, early 2019. They've grown the revenue in that time from about 120 billion to where they currently sit at 173 billion. Now, as I said, with the spinoff, that is going to decrease to, I think, around 140 billion. All right, next I want to look at shares outstanding, because this really is a good description of whether there's dilution within the company. So if we look in the last 6-7 years, they went from about 5.2 up to about 7.2. So there's some considerable dilution here. I really don't like to see that. So over the period, they've definitely added a considerable amount of shares. Now, on the earnings per share side, I'm a little surprised, mainly because I thought this would be a little bit more stable than it appears on the charts. So if you look over the course of AT&T, you can see their quarterly EPS has, I feel like, been pretty solid. You know, it's been around this 50 cents, 60 cents per share, right? But over the last, few quarters, and this includes 2020, they had a big negative here. But if you go down to the quarterly growth, you see just, big swings up and down, and I expected this to be a little bit smaller over time. For example, you see this huge win here. You see random losses over time that they take on a quarterly basis, and that really takes the trailing 12 months down quite considerably. So you would anticipate this trailing 12 months to be much smoother than it actually appears. So I'm a little surprised by that. The last 2-3 years have been pretty rough, but over the last decade, things have been pretty financially stable from a stock market perspective, as well as revenue for most companies. So I anticipated at least this period from 2011 to early 2020 to be pretty smooth, and it's just not. Next up, I want to look at AT&T's long-term debt. This is one thing that people talk about all the time, and it is one of the concerning pieces. If you saw their revenue at about 170, you can see that their current debt is a little bit less than that, about 155 billion dollars. Yes, billion dollars. This is this is a highly indebted company, and a lot of that has to do with some of their investments with DirecTV as well as WarnerMedia, and it also has to do with a high cost of capital expenditures that they have to continue their mobility and business, or their wireline segments. So while they are doing these spinoff, I believe debt is going to decrease in total, but remember their revenue will also decrease substantially, as well as their free cash flow. So just keep that in mind with AT&T moving forward. They are a high debt company, and they will be a high debt company still after they complete the spinoff. All right, next I want to look at the stock price. First, I want to look at its overall performance. So it's at $25. This is a decade low. We're going back all the way to the financial crisis. in 2009, 2010, where it was trading in that range. And then if we go back, we're looking at 2006 to 2002, where it was trading in $22 to $25 range, $27 range. So this is a really bad performance if you're taking a step back and looking how it's performed over the last 2 decades. Really poor there. Over a 5-year period, it's still very bad, looking at about a 30% decrease here. You can see pre-pandemic, it was trading about $38, dropped into the $27 range and went down to 27 many times, and then finally went to 32 and dropped back down into $25 range. Now on the 1-year chart, it looks much the same, and on the 6-month, you can really see when that spinoff was announced for WarnerMedia. You can see it drop down into the $25 range where we're currently at. And that's kind of what I anticipate to continue to happen, is the downtrend of this name until the spinoff has occurred and there's some stability in what the company is going to look like, and the people who own the stock really want to own it. I still think people are making decisions about whether or not they want to own AT&T post spinoff with WarnerMedia. All right, next up, I want to talk about some headwinds and tailwinds facing AT&T once WarnerMedia is gone. WarnerMedia was really the growth potential in the company, and one of the headwinds is low growth moving into the future. Mobility and wireline, while they are strong revenue producers for AT&T and make up majority of their income right now, they were really looking for WarnerMedia to kind of offset that into the future and have a little bit more growth for the company. But with them being gone, growth is going to be much harder to achieve as they are in very mature markets with strong competitors. On the second headwind is possible disruption. So while there are multiple folks in the game on both the mobility and wireline side, I see new entrants with big pockets such as Google Fi, and Google Fiber coming in and trying to take a little bit more market share from AT&T. I mean, there's so much revenue between Verizon and AT&T and T-Mobile that big name players see very good possibility for coming in and be a disruptor and being the low-cost solution to these companies. So this is a potential, definitely a risk for me for AT&T moving into the future. And then the second is for what they're doing, it is a high cost to entry for, which turns into a tailwind for everybody else, but it is a high cost of capital to continue your business. So they're going to have to continue to invest. AT&T has unloaded some of their debt to the companies they've spun off, but they still have a relatively high debt ratio, and they need to have that addressed if they're going to be able to continue to invest in CapEx. Just to continue the revenue on the mobility side specifically. Now on the tailwind side, there's a high cost for new entrants. Now I mentioned this before, so it's going to be a good thing for them that it costs folks a lot of money just to compete with AT&T. And as long as AT&T is, putting the CapEx where it needs to go, it's going to be even harder for companies to come in and disrupt their business. So they have a very strong moat around their business. Even their big competitors like Verizon and T-Mobile are going to have a hard time taking their market share. They have a very good brand name, and it is a very difficult company to disrupt in the short term. And that brings me to number 2. They are pretty stable for the foreseeable future. While I do see some new entrants like Google Fi and Google Fiber taking a little bit of market share over time, Google has to invest heavily in their infrastructure before that is even a thing. So at least in the foreseeable future, let's say 5 years, in my mind, AT&T has a very strong moat. And then the third tailwind that they continue to be able to use is their steady cash flow. So mobility has been around and been a key staple in AT&T and is where the core of the business has been in the last 10 years, going from wire lines to on the mobile side, and that has really taken off and continued to grow for them, but continues to have slower growth here as of late. But all that being said, the cash flow is anticipated to be very steady moving forward, at least in the next 5 years. Granted, nothing changes as far as disruptors here. All right, moving on from AT&T, let's talk about WarnerMedia as its own individual company. and what that looks like, what value it provides to AT&T, what value it provides to Discovery moving forward. So if we look at WarnerMedia's year over year or quarter over quarter growth, in Q3 of 2020, they had 56.9 million HBO Max and HBO subscribers, up to 69.4 in Q3 of 2021. Now, in my last video, I believe it was in April-May time period, the growth expectations that they had at the time was for the end of 2021 for that number to be anywhere from 67 to 70 million. So already for Q3, they've hit that target. So for Q4, going into that, they're going to go over their top estimate, in my opinion, to over that 70. And their growth expectation is to be at 120 to 150 million subscribers by 2025. So there's some considerable growth here from a subscriber perspective, and this is why people are so excited about HBO Max, which is a piece of WarnerMedia. One of the things that people talk about a lot is with WarnerMedia and HBO Max specifically that there's a lot of growth potential, and we've seen that on the subscriber side, but we haven't seen that yet make it to the revenue and EBITDA contribution side for WarnerMedia segment by itself. Now, AT&T does not break up WarnerMedia's revenue by their movie section or their HBO side of the business, the HBO Max side of the business. So it's very difficult to tell. But what we know right now with the WarnerMedia segment of AT&T is if we look over from Q1 of 2019 to Q3 of 2021, we definitely have seen overall the trend line is going down from starting at a little over $8 billion in topside revenue down to about the same level in 2021. So, 2.5 years have gone by and they're still in the same revenue place as they were 2 years ago. Now, if we move on to EBITDA, that is also on a downtrend since 2019. Again, there's been some factors there, and it's expected since the revenue basically stayed the same, EBITDA would also stay roughly the same. Hasn't been a huge decrease there. Moving on to EBITDA margin. EBITDA margin has decreased, in my opinion, quite substantially, averaging and getting to the high 30% range. Now we're in, the last 3 quarters have been 24 to 25%. Now, I think part of this is because they've taken the movies out of theaters and thrown them on the platform of HBO Max. But that could not be true. That's only speculation. But I want to see that EBITDA margin grow back into the mid-20, go around 27, 28, or potentially get up into the low 30s. So that's really what we want to see on the EBITDA margin side, but it's definitely been in a downtrend as well. So the question is, why is there really no revenue growth in the last couple years for WarnerMedia? Well, the first easy answer is the pandemic has caused a disruption in the movie business, especially during 2020 and majority of 2021. There's been very little revenue on the theatrical side of the movie business, and WarnerMedia, majority of its revenue is still coming from the movie side of the business. On the HBO side, you really have to think that HBO Max has seen a definite increase in subscriptions, but that could also be attributed to Warner offering their movies for free on HBO Max to subscribers. So while they're sacrificing some revenue growth right now, they also could be over time, especially going into 2022. Those movies may not be making their way to HBO Max immediately. They've yet to announce what they are going to do with new movie releases moving into 2022. And so that could increase their topside revenue as well as margin on the movie front, and on the HBO Max growth rate, it could stunt it a little bit if folks only signed up for, and this is just a risk here. I don't think it's definitely the case, but if people only signed up for HBO Max for the free movies that WarnerMedia was offering, that could be a potential problem for them going into 2022. I don't anticipate that to be the case, but it is a risk that you have to think about. So all that being said is, I think revenue growth will definitely grow in 2022 with movies continuing to get back to where they were pre-pandemic. We're not quite there yet. And estimates, I think, were for about a 2 to 3 year recovery. And I think it's going slower than they had originally anticipated, although it has accelerated vastly in the last 6 months. Now, just to go over quickly, HBO Max has several large competitors, such as Netflix at 213 million subscribers, Disney Plus, which is coming crazy growth and has over 116 million subscribers right now. Prime Video, which is, has other offerings as well, and a lot of people have that because of their Prime subscription, is at 170 million. Hulu at 43, Peacock at 54 million, which I'm a little skeptical of. Some of that's free, some of it's ad supported. And then Paramount Plus is at 42 million. I think some of this I'm a little skeptical of. I think some of this is subscribers, some of this is some, I'm not sure exactly what, but these numbers were much lower, 6 months when I looked at them. So I think Paramount was at 6 million, I believe, or somewhere around there, and now it's at 42 from what I looked up online. So the good news here is that some of these newer platforms like HBO Max, Peacock, and Paramount are newer to the scene in the last 6 months to a year. And they've seen, tremendous growth over 2021. And if you're looking at Peacock's growth and Paramount's growth, there could be substantial more upside for HBO Max going into the future. And they also went international with HBO Max here recently, which could also be another driving factor for their growth. All right, next up I want to talk about what AT&T and Discovery will look like post spinoff of WarnerMedia. So from the AT&T side, pre-spinoff, they had about $181 billion in revenue for 2019. Post, they're looking at $147 billion. On the free cash flow side, that moves from 27 to 20 billion. Payout ratio moving from 56 to 40 to 43%, as we discussed earlier in the dividend section. On the Discovery plus WarnerMedia side, Discovery has about $11 billion in revenue in the last year. In 2020. On the pre-side, they had a $3.1 billion in free cash flow and 0% payout ratio. That revenue is supposed to increase from $11 to $43 billion. Yes, WarnerMedia has a lot more revenue than Discovery as a whole. And even on the free cash flow side, WarnerMedia's contribution to their total free cash flow is going to be about 2/3, up to about $10 billion post spinoff. So on a total value standpoint, there's substantial decrease for AT&T on their free cash flow, and a lot of that is transferring over Discovery plus Warner. Now, if you are a share owner in AT&T, you're going to get 70% of the NewCo, which is Discovery plus Warner. If you're a current shareholder of Discovery, you're going to get 30% of the NewCo with your current shares that you own. All right, next up, I want to look at a price performance versus its peers. So on this one, we have AT&T, Verizon, T-Mobile, Discovery, and SPY all on the same charts. You can see the colors up here. AT&T is gray, Verizon's blue, gold is T-Mobile, Discovery is purple, and SPY is green. You can see the only company over the 5 years has been able to keep up with the SPY is T-Mobile. And for a majority of that time, it's stuck basically with the index. If we look at Verizon and AT&T, they're actually pretty far off from each other. Verizon's made a small increase of 10% over the last 5 years, which is very dismal. And AT&T is actually down 32% in the last 5 years. And Discovery is also down 14% in the last 5 years. So both AT&T and Discovery, as compared to other telecoms such as Verizon and T-Mobile, they are down, and they're substantially down from the SPY, the total market index there. So pretty substantial here. And for looking at AT&T and Verizon versus T-Mobile, one thing you can get indicated out of here is that growth for these larger telecoms is probably going to be stunted and less so than the smaller telecoms such as T-Mobile growing its business by adding, I believe it was Sprint at the time. So, these bigger companies are going to have a harder time with growth, and AT&T being one of the biggest definitely had a decrease in its share price accordingly, because it wasn't growing its business and didn't see much growth there. Moving on to Discovery versus some of its competitors in the space of streaming as well as entertainment overall. I put Discovery, Netflix in blue, Discovery's in gray, Netflix is in blue, Disney's in gold, AT&T's in purple, and the SPY is in green again. So Netflix has outperformed over this 5-year period, 5x in that period, has done substantially better than the SPY, and it's done better than Disney as well. The Disney has somewhat underperformed, although it at some points has overperformed the SPY over the last year, but has over the 5-year period been at 72%. So if we're looking at AT&T and Discovery, they are the two lowest on this chart from a performance perspective. What I anticipate and what I think is a potential here, going back to some of these larger companies such as Netflix, growth is going to be a little bit harder for Netflix moving forward. They've given guidance such as that. Disney has an incredible, tremendous growth rate for these streaming platforms. However, it requires substantial investment, and I think Discovery will also face that as they take on HBO Max. But one of the upsides here for Discovery is that they have not really done anything in the last 10 years, and I feel like they're finally going to have a growth trajectory that they can actually use from a streaming platform perspective with Discovery Plus as well as HBO Max. They will have 2 eggs in their basket, which they can use from a growth perspective. And I think this will be a good opportunity on the Discovery side, less so on the AT&T side here. So we'll talk a little bit more about that opportunity here, but some of that is based off of this chart and showing that they haven't really had any growth, both AT&T and Discovery, over the last 5 years. All right, so moving on to my thoughts, price target, and strategy for AT&T and Discovery moving forward. On the AT&T side, one of the things I'm worried about here is the lowering of the dividend. Due to selling some of their cash flow producing assets, they have to lower their dividend with the new company moving forward. And that's going to cause, I believe, some dividend investors to sell that asset, and it's going to honestly decrease the overall price. They've been selling a lot of their assets, so thus the price of the company is going to go down naturally. Now, the investors are getting a percentage of the new company, so there is some offset there, but the stock itself, the individual asset of AT&T, the company, is going to go down in value, so that stock price by itself will continue to drag down until the spinoff and some stabilization happens. I think AT&T has a simplified business model. They're going kind of back to their core of their business. No real streaming, no real growth prospects moving forward, and this is really a problem for investors that are really wanting to see growth and capital appreciation. I think it may be stable for those who want a steady dividend post spinoff, but for those right now, it still may be an uncomfortable dividend cut in the short term, as well as some capital depreciation, in my opinion. So one of the things, my margin of safety here is I'm not really looking at AT&T from a price perspective until they get around $23 a share, where I think there is some level of safety with the future dividend, as well as future dividend yield, as well as just some capital appreciation risk, in my opinion. So $23 is where I'm going to revisit whether or not I want to enter into a position with AT&T specifically. With the spinoff of WarnerMedia, the attractiveness of AT&T has gone down substantially. The price target from 32 to 34, which I produced back in April prior to the news, That's totally out the window. That's why I sold my shares. This is not a very attractive stock and has pretty bad sentiment overall, as their growth prospects have gone out the window and the company is less sexy and less appealing to overall investors. But I do think that sexiness and the lack of will change over time, and there will be an opportunity to possibly get AT&T as long as they're able to overcome some of the headwinds they're facing, such as disruptors moving into the market and some other things. Now, before we move on from AT&T, I just want to note that if the price of AT&T gets substantial and is good enough, I think it could warrant a purchase for a percentage of the NewCo and then sell your AT&T assets after the spinoff. Now, moving on to Discovery. Discovery had a 2020 where they went into the $20 range, and they had this astronomical rise up into the $70 range. And I thought, there's no way post spinoff that is going to be substantiated, at least in the near term. And the stock price has continued to decrease all the way back into the $23 range, which is still lower than they were pre-pandemic, around $30 range then. But I do still think that there is substantial opportunity with Discovery itself as a new company with the addition of WarnerMedia. WarnerMedia has the assets to produce the new content that HBO Max needs, as well as Discovery Plus. And I think they can really leverage that relationship to really produce high quality content, as well as get it out there and provide a lot of value to their customers. With these streaming platforms, they have to produce a ton of new content in order to keep people on the platform, and they have to be able to sustain that. And I think WarnerMedia at least has the infrastructure to assist with Discovery's NewCo moving forward. Now, I do anticipate there may be a run-up in AT&T's name right before the spinoff, as well as maybe Discovery. And the reason why I think there might be a slight uptick in AT&T's name right before the spinoff is you get 70% of the NewCo, and I think it offers a little bit more value than Discovery if you're buying them outright in anticipation of holding the NewCo in the future. Now, Discovery's share price has been definitely getting more and more tempting, and with them being lower than their pre-pandemic levels, they're also a little bit tempting, such as AT&T. So it's a really tough decision between choosing one or the other. Now, what I do anticipate is definitely after the spinoff, there should be, or most likely will be, a runoff of the NewCo. I think there's a lot of growth opportunities, a lot of that consolidation of the business, I believe, is going to provide some value. I think it'll be a good short-term trade. I think there may be a run-up and then a decrease substantially after things start to level off. People sell their short-term gains on the name. But I do think overall NewCo, Discovery plus WarnerMedia is going to be more of a long-term investment, which has the potential to make good returns like Netflix over time, outperforming the S&P 500. Whether or not is that going to happen in the next 6 months? No, in my opinion. But I think this is something you have to pay attention to pretty closely if you want to time it right. And for me personally, AT&T looks attractive at about 23. Discovery probably looks attractive in the $22, $21 range. If they get into $20 range, Discovery looks even better. So I'm going to keep my eyes focused on AT&T moving forward as they get close to the spinoff. NewCo looks very attractive to me, but I don't want anything to do with AT&T right now because we have this dividend issue, and I think people will continue to sell on news that the dividend will decrease after spinoff. And Discovery, you just don't get enough of the new business, in my opinion, to warrant the current value of the company. But once it merges, I believe there is probably going to be a run-up of the name in anticipation of folks, wanting a piece of that NewCo. So there's going to be a time, I think, in the near future, 6 months from now, when Q2, when this closes, there's going to be a lot of action. A lot of folks are going to be talking about AT&T and Discovery. Discovery's NewCo. So keep an eye out on this one. There's going to be a lot of movement, in my opinion, and I'll cover it as we go forward. Thanks so much for watching today's rather long video. It's longer than what I normally do. If you like this type of content, please hit that thumbs up button. It helps me out so much. I really do appreciate it. If you like this type of content, also please subscribe to my channel. It helps with the growth. It helps with telling me if I'm doing a good job or not. Leave a comment down below. Let me know what you think of AT&T or Discovery. Do you plan to own any of these pre-spinoff? And if so, why? Just let me know. I always respond to my comments down below. So thanks so much for watching. My name is Frank Finance, out.